Hello learners, today we begin with the new topic, that is working capital and working capital management. If you remember, in my initial videos we had talked about what working capital is. When we were discussing the scope of finance manager's role, then we discussed what working capital is. Today we will focus on the same working capital aspect, that is what is working capital and how management of working capital is done. If you see, working capital in general we say requirement of funds for day-to-day activities, but conceptually it has two viewpoints, static approach or dynamic approach. Static viewpoint means when we visualize the working capital from the balance sheet aspect, or balance sheet data is taken to arrive at the working capital. Now, static approach says working capital can be gross working capital, which means sum total of current assets, and it can be net working capital, that is sum total of current assets minus sum total of current liabilities, that is difference between current assets and current liabilities. So, for a finance manager, what is more important out of these two, gross working capital or net working capital? I will say both are important. Gross working capital simply means how much investment is required in the different current assets. Different current assets are the one which are either in the form of cash or likely to be converted into cash within 1 year or one operating cycle. These might include cash in hand, cash at bank, receivables, that is accounts receivables or trade receivables, or in general we say sundry debtors, inventory of every kind, raw material, finished goods, semi-finished goods, and it also includes prepaid expenses. So, all those are the baskets of current assets, whereas current liabilities, the liabilities which are to be paid within 1 year or one operating cycle. These generally include expenses payable, trade payables, also known as sundry creditors, or tax payable, dividend payable, and likewise. Now, gross working capital tells me how much total investment is required in current assets, whereas net working capital, as you see, total current assets minus total current liabilities, tells me how much funds of the organization have been involved in the working capital. If I say gross working capital, that is sum total of current assets is 1000 and net working capital is only 300. That simply implies that for sustaining a particular level of activity, so let me write down the level of activity also. So, if suppose for a particular financial year we pick up the balance sheet as well as the income statement and we come to know total current assets are 1000 and total current liabilities are 700, that is where we arrive at net working capital 300, 1000 minus 700, and sales during that year was 12,000. It may be crores, millions, trillions, billions, whatever it may be, any denomination you can give it. Now, we can simply say to support a sales level of 12,000 crore, if it is in crores, our investment in total current assets is 1000 crore, whereas net working capital is 300 crore. Although total current assets requirement is 1000 crore, but how much organization funds are blocked into financing the working capital, that is 300 crore. So, in that way static viewpoint tells me what was the amount of working capital. Similarly, we can take the data of projected income statement and projected balance sheet and come to know how much is the total investment in current assets and what is my net working capital. Now, why we say this is static? It is static in the sense we are using balance sheet data, we are relying on balance sheet data, and balance sheet, if you remember, it is always prepared as on a date, because balance sheet will reflect different assets and liabilities as on a particular date, the date of balance sheet. So, that is why it is static. At this point of time we find that working capital requirement is 300 crore. That means company needs to invest 300 crore in the working capital. However, remember, in reality 300 might not be the real picture of working capital. Reason being, working capital might change with the season to season, cycle to cycle, business cycle and all that. So, therefore, static viewpoint is simply relying on the data given in the balance sheet, and balance sheet has its own limitation. It depicts different assets and liabilities as on a particular date. Then second viewpoint is dynamic approach. Now, what dynamic approach tells me? Dynamic approach tells me requirement of working capital for day to day expenses, requirement of working capital resulting from operating cycle. Now, every business has got a operating cycle. If it is a trading business, then different trading cycle will be there or operating cycle will be there. If it is manufacturing business, that is industry, different operating cycle will be there. So, for a trading company, what is the operating cycle? We start with the cash. With this cash, goods are purchased. So, we will have inventory of finished goods, because this company is simply buying the ready made goods and selling it. Like there are many big business houses also doing that. Then these goods are sold out. So, sales takes place. Now, sales, if it is in cash, it will immediately get converted into cash. However, if we have credit sales, we get receivables, and those receivables will be realized subsequently. Those receivables will be realized subsequently. So, this is particularly the operating cycle. And duration of the operating cycle, activities involved in the operating cycle will affect requirement of working capital. In general, longer the duration, higher will be the requirement of working capital. Shorter the duration, lower will be the requirement of working capital. And the same is affected by trade payables also. That is accounts payable or trade payable, or you can say sundry creditors. If we say in this particular operating cycle 1000 crore is involved, but 700 crore is financed, 800 crore is financed from payables, outstanding expenses, trade payables and something like that. So, how much of the own funds are blocked into this working capital? 200. But yes, dynamic viewpoint is more near the reality, because this viewpoint assumes two level of working capitals. I will explain that also. So, this is the operating cycle of a trading business. Similarly, operating cycle of manufacturing business may be like this. We begin with cash, we buy raw material, that raw material is processed. That means we are spending some money on that by paying electricity expenses, conversion charges, raw material, finishing charges and all that. So, it will become semi-finished goods, then it will become finished goods, then sales takes place, and if sales is done in cash, there is no credit sales, then immediately cash will come. However, if credit sales is there, we will have receivables, and these receivables will get converted into cash. So, that is the operating cycle of manufacturing company or an industry. So, this is the way we simply see dynamic approach is more dependent upon operating cycle. Now, according to dynamic approach, what are the two different levels of working capital? We will see that. So, according to dynamic approach, there can be two kind of working capitals: permanent working capital and temporary working capital. Now, what is permanent working capital? Permanent working capital means that amount of working capital which is required throughout the year to sustain normal operating activities or normal trading activities or average trading activities. So, if suppose on an average a particular level of production and sales takes place, how much of the working capital will be required throughout the year? That is called as permanent working capital. Whereas temporary working capital, which is also known as variable working capital or fluctuating working capital, amount of working capital which is required to sustain or support fluctuations in the trading activities, that is resulting from the cyclical and seasonal changes. If suppose we are talking about woolen industry, in a woolen industry requirement of working capital will be very high during the winter season, or requirement of working capital will be very high when they procure the raw material. It means amount of working capital will keep on changing in that period. That will be additional working capital or temporary working capital. So, graphically we can show it like this. This is fixed working capital or permanent working capital. You can say PWC, permanent working capital, that means throughout the year. So, this is the year long period and this is the amount. So, that level of working capital is permanent. However, temporary working capital will keep on changing. Temporary working capital will keep on changing. During the peak season, amount extra will be needed. The moment the season goes away, we need not to go for the additional amount. So, this is the way temporary working capital will be there or variable working capital. So, according to dynamic approach, two levels of working capital we have to focus on. Then what are the components of working capital? Components of working capital are two: current assets and current liabilities. Current assets are the one which are either in the form of cash or likely to be converted into cash within 1 year or one operating cycle, whatever is later. In some cases operating cycle, although nowadays it is never there beyond 365 days, but yes, earlier it used to be there. So, generally we say yes, current assets are the one which are either in the form of cash or likely to be converted into cash within 1 year, and these include inventory or stock, receivables, that is trade receivables, also known as trade debtors or sundry debtors, short term investment and cash and bank balance. Short term investment, sometimes what happens, company has a surplus cash and that surplus cash is invested in treasury bills or government bonds or in bank FDR, so that for the time being company can earn interest on that idle funds, and subsequently when season comes, funds are required, they will be used for operating purpose. So, that is short term investment. And then we have the prepaid expenses, salary paid in advance, rent paid in advance and something like that. All those expenses fall in the category of current assets. Then current liabilities. Liabilities which are to be paid within 1 year or during one operating cycle. So, generally we take 1 year. Yes, these includes trade payables, also known as sundry creditors. It may be bills payables, the bills against which payment is yet to be paid, expenses payables, it may be short term loan or bank overdraft. So, all those fall in the category of current liabilities. So, this is the way components of working capital are there. Then question comes, why we need to manage working capital? So, meaning of working capital we have understood very well. Two approaches: static approach which originates from balance sheet data and dynamic approach which says requirement of working capital is due to operating cycle. Operating cycle approach is also known as pipeline theory. Why pipeline theory? Because to sustain the basic level of operating activities, normal level of operating activities, round the year some minimum level of funds will be invested in the working capital elements, because different current assets, debtors, inventory, prepaid expenses originate from the operating cycle, and as I said, longer the operating cycle, higher will be the requirement of working capital and vice versa. So, now when we need the working capital throughout the year, according to dynamic viewpoint, operating cycle is the one which affects the working capital requirement. Now question comes, why we need to manage it? Because you might say it is resulting from the flow of business activity, but yes, we need to manage it. The purpose is to maintain liquidity profitability trade-off, because one of the primary function under working capital management, or I can say one of the primary objective under the working capital management is ensuring liquidity profitability trade-off. Now what is liquidity profitability trade-off? With reference to working capital, liquidity means ensuring that we have sufficient availability of raw material, we have sufficient availability of finished goods so that we never say no to customer. We have sufficient raw material and ancillaries so that operating activities can continue smoothly. That is ensuring liquidity, and that can come only through efficient working capital management. Then profitability, because one might say when we have to ensure the liquidity, stock, as much stock you can do, as much inventory you can stock. Like if I say annual requirement of inventory is 24,000 units, in a average way we can say 2,000 units per month are required. And when we say we have to ensure liquidity, so one might say procure the 24,000 units on the very first day of the year and just relax. Working capital management is not required then, but buying the 24,000 unit in one go will require heavy investment in working capital, that is heavy investment in inventory. Second thing, it will require larger size of the warehouse where these 24,000 units can be stored. So we are losing the opportunity cost, we are incurring extra money on the warehouse and upkeep and safety of the inventory. And foremost, what is that? This inventory may be subject to proliferation. Proliferation means it might get stolen, its quality might get deteriorated, and some other misuse might be there. Therefore, procuring 24,000 units in one go may not be a viable decision or wise decision or advisable. And because when you procure 24,000 at one go, it will lower down your profitability. So idea will be there, we will be reaching at an optimum level of inventory at which liquidity as well as profitability both are maintained. So by maintaining profitability means we are going into consideration of benefit cost ratio. That means to say for every level of inventory is an example. Similarly for receivables we might have an example. So for every level of an inventory we need to find out what are the benefits and what are the costs. And the point at which we arrive at a balance between liquidity and profitability will be the optimum level of inventory. So that we will be learning under inventory control or inventory management. So that is why working capital management is required to ensure liquidity and profitability. We proceed further. Now question comes, before discussing what is working capital management, because working capital management definition is simple. Applying the different managerial policies and strategies for the effective planning of working capital, procurement of working capital, as well as controlling the working capital aspects. So that is working capital. So I repeat it again, working capital management means designing and applying effective policies and strategies for the efficient and effective planning for working capital. That means how much working capital we need. Then designing a strategy to procure that working capital, arranging, and lastly once working capital elements have been procured, we have to control that so that profitability and liquidity both can be ensured. So working capital management is planning, organizing and controlling different elements of working capital. That is working capital management. Now question comes, few companies require larger amount of working capital, few companies require lower amount of working capital. So what are the factors which affect working capital requirement? If you see nature of business, if your business is of cyclical nature, seasonal nature, then definitely there will be wider variation in the working capital requirement. Take a simple example, if you are a grain merchant, let us say wheat. So, you are dealing in wheat only. So, your wheat procurement will be very high during March, April when crop season is there, and that crop procured in March, April will be sold out throughout the year. So, your working capital requirement during that particular season will be very high. Whereas, if you are in the woolen industry, woolen garments, your inventory requirement will be very high during the winter season. So, it depends what is the nature of business. Whereas, if you are simply buying the salt, processing it and selling the salt. Now, salt never changes, or consumption of salt very rarely changes with the seasonal and cyclical fluctuation. Therefore, your working capital requirement will be very much stable, very much stable. Or if you are dealing in some other products which do not get affected by the season, then definitely your working capital requirement will be stable or normal. Then comes seasonality of raw material, I have discussed. Nature, again we can say nature wise, what is your nature of business? Are you operating in multiple business or multiple products? If you are operating in multiple products, yes, more inventory is required. Nature of business can also be there. If suppose you are in a product which has got higher gestation period, which has got higher production period, that means processing time is very long, then your heavy investment will be there in the inventory. Heavy investment will be there in ancillaries. Or if you are in an industry in which too much of the breakdown and repairing of the machinery is required, then you need to keep ready the stock of equipments or stock of spare parts. Therefore, nature of business can be discussed like that also. Seasonality we have already discussed. Seasonality of output. So, seasonality of input and output both have to be taken into consideration for deciding working capital requirement. Then comes scale of operations. If you are operating in a zonal area, like your area is village, city or at the most district, your requirement of working capital will be very low. If you compare, grocery shops are there near your home, and you can compare the similar kind of mega mart, large malls are there. They are also selling the same product, and a shopkeeper near your house is also selling the same product, and you can see the shopkeeper near your house has less inventory. He might not give credit to people, or he might give credit to people, that is something different. But when you talk about inventory, he might stock the limited quantum of inventory. Whereas big warehouses or big business houses, malls are there, they are selling the same product, grocery items, then their requirement of working capital will be very high. They will be buying in bulk and selling in bulk. Or you can say, if you are a wholesaler, you buy in bulk, sell in bulk. If you are a retailer, you buy in bulk, you sell in bulk. It means these points, nature of business and scale of operations, can be clubbed together also, can be discussed separately also, depending upon what you want to discuss in the examination. So, these were the things were affecting the inventory level. Now, question comes, there are other components of working capital also. So, what will affect that? So, let us say trade receivables or trade payables. So, we have trade practices. They will affect investment in receivables. If suppose a business house says we will never give any credit to anyone, then their investment in receivables is zero. But remind you, when you do not give any credit, whereas your competitors are giving the credit, definitely your sales might be down. So, your sales will get affected, and if sales is affected, profit will get affected. So, in that way, trade practice, what kind of credit policy you have, how much credit you give it to the customer. Similarly, a company might design a policy in which they categorize the customers into different categories: A category customers, B category customers and C category customers. A category customers are the one who are prompt in paying the money. They never delay, never default. Whereas C category might delay, might default also. So, now if your trade practice is giving credit only to A category customers, then probability is that sales will be low, your funds invested in receivables will be low, whereas your competitor is giving credit to every kind of customer, A, B and C. then his investment in receivables will be very high, probability of sales is very high, and then yes, we might say chances of bad debts are also very high, chances of profit are also very high. So, risk is there. So, trade practice affects the investment in receivables. Similarly, trade policy of the company. So, trade practices and trade policies are little bit different. Practice is you going along with the market, changing your credit policy, changing your inventory policy along with the market wide factors, keeping into consideration competitors. Whereas, trade policy may be one standard policy, that yes, we will never deviate from our policy of giving credit or not giving credit. Or it may be there that to look at the fact giving discount. If you give discount to your customer, then probability is that sales will rise. The moment discount offer is announced, your heavy investment will be there in the inventory. Your heavy investment may be there in cash. So, in that way trade policy and trade practices little bit overlap, but yes, that can be there. Then level of competition. In an industry there is no competition. If there is no competition, then definitely people might say, okay, I am the king, I am the one seller only, whatever credit I give, I will give it, I will not liberate, I will not be a liberal one. In that case, your investment in receivables will be less. If level of competition is very high, that means customer is not brand loyal or product loyal or shop loyal, then definitely the customer will move to a particular supplier who is giving more credit. In that case, we are forced to follow the market wide policy of giving more credit. In that case, credit for the longer time duration is given, and the moment you make the credit period longer, your investment in receivables will be very high. Similarly, we might have other factors. Other factors will affect, are you going to get credit facility from your supplier? If suppose you are established businessman in the market, age old business is there, then definitely suppliers might give you credit. Whereas if you are new entrant in a business, sometimes suppliers might not give you the credit. Similarly, what is the level of competition among suppliers? That will also affect your investment in receivables or payables, both the things. Look at the fact, if suppliers are not having a competition, that one supplier is giving a credit for 24 days, another is giving for 60 days, and both are selling same product, no price deviation, then definitely you will buy from the supplier who is giving 60 days credit. And the moment you go for that supplier, your investment in inventory becomes low. And that particular thing might motivate you to change your policy also, because you are getting a credit for longer time duration. Then definitely you might be tempted to give longer credit to your customer also. So, competitors' policy will affect your investment as well as your policy also. So, in that way a broader perspective is kept into consideration. So, these are the factors which affect working capital needs. There may be many more also depending upon industry to industry, business to business and region to region. Then what is working capital management? As explained earlier, working capital management is about planning for working capital, arranging for working capital and controlling the working capital. Now, when it comes to discuss these, we will be discussing under planning part, how much working capital is required for a particular level of business activity. If suppose your business organization is planning to go for production of 20 lakh units of a one particular item next year. So, for the production of those 20 lakh units, how much working capital is required? That will be planning for working capital. That means estimation of working capital needs. Estimation of working capital. Then arranging for working capital. So, once we have decided, let us say 150 crore is required to sustain a particular level of activity for the next year. In that case, from where this 150 crore will come? We will be arranging for that financing. So, it is financing of working capital. It will be financing of working capital. And then lastly will be controlling the working capital. So, under control aspect, we will have prominently inventory control and receivables control. Inventory and receivables, which are known as trade debtors, So, this will be the complete coverage. Now, what we will be doing? We will be beginning with the estimation part. From the subsequent lesson, estimation basically will be done about how much investment is required in current assets. That means to say, to sustain a particular level of activity, how much investment will be there in raw material, in semi-finished goods, in finished goods. How much our funds will be blocked into receivables. That means estimating different current assets. And at the same time, we will estimate different current liabilities. And as you know, if my current assets are going to be 20 crores, current liabilities are going to be 12 crore. So, how much I need to arrange for? I need to arrange for only 8 crore. So, that simply says that for a particular level of activity, if my level of current assets is 20 crore, current liability level is 12 crore. So, business organization need to think about financing 8 crore gap only, and that will be under financing. Now, if this 8 crore is permanent working capital, we might go for the long term sources of financing. If out of this 8 crore, again a bifurcation comes, 6 crore is permanent working capital and 2 crore is temporary working capital. Then 6 crore will be financed through long term sources and 2 crore will be financed through short term sources. So, once we have the estimation, we will be going in for the financing. And once financing has been done, it means we have procured the raw material, receivables are there, payables are there. Prominently, we will be talking about how to control the inventory and how to control or manage receivables. So, in that way, that will be the complete coverage of working capital aspects which we will be discussing. It will be a blend of theory and numerical, more of theory and less of numerical. Numerical will come either in the estimation or inventory control. So, that is the way working capital aspect are discussed. I hope you have understood the working capital aspect. Always differentiate between static viewpoint and dynamic viewpoint. Static viewpoint may or may not coincide with the reality, whereas dynamic viewpoint is likely to coincide with the reality because it talks about the level of working capital for day-to-day activities or amount of working capital required for day-to-day activities to sustain permanent activities, that is average or normal business activity, as well as seasonal changes or cyclical changes in the business activity. So, this much I hope is sufficient in this particular conceptual part of working capital. In the next video, we are going to discuss about estimation of working capital. Till then, keep on learning. Thank you for giving me your time. Thank you.